The year 2008 will forever be etched in financial history as a time of extraordinary turmoil. The world watched in disbelief as seemingly invincible institutions teetered on the brink of collapse. What began as a crisis in the US housing market quickly morphed into a global financial meltdown, leaving millions jobless, countless homes lost, and economies shattered. The seeds of this crisis, however, were sown years earlier, hidden in the shadows of a booming economy and fueled by unchecked greed and a dangerous disregard for risk. The American dream of home ownership was being peddled as a surefire path to wealth. Lenders eager to cash in relaxed their standards, offering mortgages to borrowers with poor credit and low incomes. These subprime mortgages, packaged and sold as complex financial instruments, spread throughout the financial system like a virus. Few questioned the sustainability of this debt-fueled bubble, blinded by soaring home prices and the allure of easy profits. As early as 2006, cracks began to appear in the foundation, housing prices peaked and then began a steady decline. Borrowers, many of whom had taken on mortgages they could barely afford, started to default. Foreclosures mounted, further depressing home values and setting off a vicious cycle of decline. The subprime mortgage market, once a cash cow, was now a ticking time bomb. The implosion of the subprime mortgage market sent shockwaves throughout the financial system. Wall Street firms, heavily invested in these mortgage-backed securities, faced staggering losses. Banks, fearing further losses, became reluctant to lend to each other, effectively freezing credit markets. The lifeblood of the global economy, credit, was drying up. The crisis quickly spread beyond the borders of the United States. European banks, holding vast quantities of toxic American mortgage-backed securities, were also caught in the downdraft. Global stock markets plunged as investors panicked, selling off assets and seeking safety in cash. The interconnectedness of the global financial system, once a source of strength, had become a conduit for contagion. At the helm of the US Treasury Department was Henry M. Paulson, Jr., a former Goldman Sachs CEO thrust into the eye of the storm. Paulson, known for his calm demeanor and decisive leadership, faced an unprecedented challenge. The financial system was teetering on the precipice, and the specter of a full-blown economic depression loomed large. As the crisis deepened, Paulson and his team at Treasury worked feverishly to contain the damage. They faced a series of agonizing decisions, each carrying enormous consequences. Should they intervene in the markets, propping up failing institutions? Or should they let the market run its course, even if it meant a painful and protracted downturn? The first major casualty of the crisis came in March 2008 when Bear Stearns, a venerable Wall Street investment bank, collapsed under the weight of its subprime mortgage losses. Fearing a systemic meltdown, the Federal Reserve, led by Ben Bernanke, orchestrated a fire sale of Bear Stearns to J.P. Morgan Chase, effectively nationalizing the bank's bad debts. The Bear Stearns bailout, while controversial, was seen as a necessary evil to avert a wider panic. It signaled, however, that perhaps some institutions were too big to fail. The government, it seemed, was willing to intervene in the markets to prevent a complete financial collapse. This realization, while initially reassuring, would have unintended consequences. In September 2008, the crisis reached a fever pitch with the collapse of Lehman Brothers, another Wall Street giant. Unlike Bear Stearns, Lehman was allowed to fail, sending shockwaves through the global financial system. The Dow Jones Industrial Average plummeted over 770 points, its largest single-day point loss ever. Panic gripped the markets as investors realized the full extent of the crisis. The Lehman Brothers bankruptcy marked a turning point in the crisis. It shattered the illusion of invincibility surrounding Wall Street and exposed the fragility of the global financial system. The government, once hesitant to intervene, found itself forced to take unprecedented actions to prevent a complete financial meltdown. The collapse of Lehman Brothers sent shockwaves across the globe, triggering a financial panic of unprecedented proportions. This event marked the beginning of a financial crisis that would ripple through every corner of the world, affecting economies both large and small. The sudden downfall of such a major financial institution was a stark reminder of the fragility of the global financial system. It wasn't just a single company's failure. It was a symptom of deeper, systemic issues that had been building up for years. The immediate aftermath saw a scramble for safety as investors and institutions alike sought to protect their assets from the ensuing chaos. Stock markets from Tokyo to London plunged into freefall, mirroring the fear and uncertainty that gripped Wall Street. The dramatic drops in stock prices were not just numbers on a screen, they represented the loss of trillions of dollars in wealth, affecting millions of people worldwide. Retirement funds, savings accounts, and investment portfolios were all hit hard, leading to widespread panic and a loss of confidence in the financial system. The volatility in the markets was a clear indication of the deep-seated fear that had taken hold, as investors grappled with the reality of a potential global economic collapse. Credit markets, already strained, seized up entirely as banks, fearing further losses, refused to lend to each other. This freeze in lending had a cascading effect on businesses and consumers alike. Companies found it increasingly difficult to secure the financing they needed to operate, leading to layoffs and cutbacks. Consumers, facing tighter credit conditions, reduced their spending, further exacerbating the economic downturn. The lack of trust between financial institutions was a critical factor in the deepening crisis, as the flow of money, the lifeblood of the economy, came to a grinding halt. The interconnected nature of the global financial system, once a source of stability and growth, had become a conduit for contagion. What started as a crisis in the United States quickly spread to other parts of the world, highlighting the vulnerabilities of a system that was supposed to be resilient. The very connections that had facilitated global trade and investment now served as pathways for financial distress. Countries that had little to do with the initial causes of the crisis found themselves caught in its web, as the effects of the downturn spread through trade links, investment flows, and financial markets. European banks, heavily exposed to toxic American mortgage-backed securities, found themselves teetering on the brink. These securities, once considered safe investments, had turned into financial time bombs, threatening the stability of banks across the continent. The exposure to these toxic assets led to massive write-downs and losses, eroding the capital base of many financial institutions. Governments and central banks in Europe were forced to step in, providing emergency funding and guarantees to prevent a complete collapse of their banking systems. The crisis revealed the extent to which European banks had become entangled in the risky practices that had originated in the United States. Governments around the world scrambled to contain the damage, injecting billions into their financial systems and enacting emergency measures to prevent a complete collapse. These measures included bailouts for banks, stimulus packages to boost economic activity, and coordinated efforts to stabilize financial markets. The scale of the intervention was unprecedented, reflecting the severity of the crisis and the urgent need to restore confidence. Policymakers faced the daunting task of balancing immediate relief with long-term reforms to address the underlying issues that had led to the crisis. The actions taken during this period would shape the global economy for years to come. The crisis exposed the weaknesses of a globalized financial system that had grown increasingly complex and opaque. The intricate web of financial instruments and transactions had become so convoluted that even seasoned professionals struggled to understand the full extent of the risks involved. This lack of transparency made it difficult to assess the true health of financial institutions and markets, contributing to the panic and uncertainty. The crisis underscored the need for greater oversight and regulation to ensure that the financial system could function effectively and safely. It also highlighted the importance of simplicity and clarity in financial products and practices. Years of deregulation and lax oversight had created an environment ripe for excessive risk-taking. Financial institutions, emboldened by the lack of constraints, had pushed the boundaries of what was considered prudent and responsible. The pursuit of higher returns led to the creation of increasingly complex and risky financial products, which were often poorly understood by both investors and regulators. The regulatory framework, designed for a simpler era, struggled to keep pace with the rapid innovation and growth of the financial sector. This disconnect between regulation and market practices was a key factor in the build-up of systemic risk. Financial institutions, driven by greed and short-term profits, had engaged in reckless lending practices and complex financial engineering, the consequences of which were now being felt worldwide. The aggressive pursuit of profit had led to a culture of risk-taking and short-termism, where the potential long-term consequences were often ignored. The widespread use of leverage amplified the impact of the crisis, as losses were magnified and financial stability was undermined. The fallout from these practices was not limited to the financial sector. It had far-reaching implications for the broader economy and society as a whole. As the crisis deepened, the International Monetary Fund, IMF, warned of a global recession, the likes of which had not been seen since the Great Depression. The IMF's dire predictions underscored the gravity of the situation and the urgent need for coordinated action. The prospect of a prolonged and severe economic downturn loomed large, with potential consequences for employment, income, and social stability. The warning served as a wake-up call for policymakers and the public alike, highlighting the need for decisive and effective measures to address the crisis and support recovery. The world held its breath, bracing for the worst. The uncertainty and fear that had gripped financial markets spread to households and businesses, as people worried about their jobs, savings, and future prospects. The psychological impact of the crisis was profound, affecting consumer and business confidence and leading to a vicious cycle of reduced spending and investment. The sense of impending doom was palpable as the global economy teetered on the edge of a precipice. The stakes were incredibly high, and the actions taken in the coming months would determine the course of the global economy for years to come. The fate of the global economy now rested in the hands of policymakers who faced the daunting task of restoring confidence and averting a complete financial meltdown. The challenge was immense, requiring a delicate balance between immediate crisis management and long-term reform. Policymakers had to navigate a complex landscape of competing interests and priorities, while also addressing the root causes of the crisis. The decisions made during this critical period would have lasting implications for the global financial system and the broader economy. The world watched anxiously, hoping that the right choices would be made to steer the economy back to stability and growth.